Welcome everyone. This session is designed to be your comprehensive deep dive into the core of financial analysis, the technical analysis and the security valuation. Over the next hour, we're not just going to run through formulas, we're going to build a mental framework. So you're the analyst, and this final exam is your opportunity to demonstrate that you can bridge the gap between market psychology and the rigorous financial modeling. So we will explore how to identify market turning points using technical tools and how to define true economic worth using valuation models. So by the time we reach the final slide, you will have a clear step-by-step logic for how to approach any problem on the exam. And let us begin with the foundation of technical analysis. It is often misunderstood as a chart reading, but it's actually the study of market psychology. We operate on three fundamental assumptions. First, the market value is governed entirely by supply and demand. If there are more buyers than sellers, the price rises. It's so simple. And second, we assume that prices move in trends that persist for long durations. And this is the concept of market memory. Trends don't just stop instantly. They have momentum. Third, and perhaps most importantly, history repeats itself. Because human emotions like fear and greed are constant, the patterns created by those emotions in the past are bound to recur. The benefit here is the ability to bypass the uncertainty of accounting data and respond immediately to trend reversals. Now, how do we visualize this psychology of the investors? We use the candlestick chart. A candle is not just a shape, it is a battle report. It displays the open, high, low, and closing price for a specific time window. And when you see a bullish, often red candle, it tells you that buyers won the battle, pushing the close above the open price. And a bearish, often blue candle indicates that sellers dominated, pushing the close below the open price. But there is the most critical technical rule. A volume confirms the price. This is the very important part, so please memorize that the volume confirms the price. If the price surges but the volume bar underneath is say tiny, do not trust the movement. And high volume is the proof that the market agrees with the price change. So if you try to analyze the chart pattern, you have to first analyze the price movement, and you have to also look at the volume trends. So try to check if the volume confirms the price movement. So always analyze the price action in the context of the volume behind it. And patterns are the visual history of the market struggle. We categorize them into two buckets. First, we have reversal patterns, such as the head and shoulders, or double tops or bottoms. And this signals that a trend is exhausting itself. Think of a head and shoulder like here as a failed recovery attempt. The market tries to push higher and fails, and a failed rally confirms the trend is dying. And second, we have a continuation pattern, such as triangles and rectangles. These are not turning points. They are periods of a consolidation. The market is taking a breath. Once the price breaks out of these shapes, the original trend usually resumes with renewed strength. So continue. On the exam, identifying this isn't just enough. You must explain why they suggest a trend change or continuation. And indicators add mathematical precision to our chart work. We use them to filter out the noise, of daily price fluctuations. So the moving average is our trend smoothing tool. A golden cross occurs when a short-term moving average crosses above a long-term moving average, signaling a shift in power from sellers to buyers. Then we have Bollinger Bands, which helps us measure volatility. So this Bollinger Bands measure volatility. It's known as a variance, or the standard deviation of the stock, a risk. If price breaks outside this bands, the market is stretched thin. It's a warning. And finally, the RSI, or Relative Strength Index, is your momentum oscillator. And if the RSI index goes above 70, the asset is overbought, too much greed. If it drops below 30, it is oversold, too much fear. Use this as a guardrails, not crystal balls. Now we transition from the psychology of when to the logic of what. Security valuation is a systematic process. So first, you must determine your required return, the discount rate. So this is the discount rate. To discount, to estimate, to calculate the present value of the future expected cash flows, such as dividend or the free cash flow of the firm. And the discount rate could be either the cost of equity derived by some theoretical model, such as capital asset pricing model, or the weighted average cost of capital. And this is the first hurdle rate derived from CAPM, or your cost of capital, WACC. And second, you have to calculate the intrinsic value by discounting your expected future cash flows. And the logic is called and calculated. If the intrinsic value is greater than the current market price, the asset is considered undervalued. So it's a signal to buy. It's cheap. And if the market price is higher than the intrinsic value, the asset is overvalued. So you have to avoid it. You have to sell it, or you should not buy it. You avoid it. This is the bedrock of fundamental analysis. And there are two approaches to this process. The top-down approach is like you start with a macro environment. So you start with macro analysis, global GDP or interest rate or inflation rates. And if the macro environment is poor, even the best companies struggle. So you believe even the good companies may drop with their earnings if the macro environment is poor. And so once you settle on a positive macro view, you move to the industrial analysis to select promising sectors. And finally, within that sector you believe which is promising or bright, has bright futures, you perform firm analysis to pick the specific stock, to pick the individual stock. In contrast, the bottom-up approach is about individual stock selection. It focuses on the finding undervalued stock, regardless of what the broader industry is doing or the macroeconomic doing. Both are valid, but on the exam, you need to be able to argue which one fits the specific market scenario presented to you. So you will be able to discuss about the difference between the top-down approach and the bottom-up approach. And we have a universal theory for valuation. And financial asset value is the present value of all future cash flows over the holding period. So here is the formula you must know. So this cash flow could be either a dividend or the free cash flow to the firm. And this discount rate is the required rate of return. Say it could be either cost of equity or the weighted average cost of capital. And if you assume you're holding the firm indefinitely, you could apply some constant growth model, say the 1 over KE minus G, if you assume the growth rate is constant for the cash flow streams. So this formula is everything. So if this discount rate or the interest rate rise, the value must drop. If the cash flow increases, the value rises. So never forget that denominator, the discount rate. It's just important as the cash flow itself. And for common stocks, things get interesting because companies grow. So if you expect a stable growth, we use the Gordon's constant growth model, as I mentioned just right before this slide. So the G is the growth rate. And if the growth equals or exceeds your required rate of return, this model breaks down. So for growth stocks that don't pay dividends, we can use free cash flow approach. So we use free cash flow to the firm when we want to value the whole company, the value of the firm, not the value of the equity. So recall that the value of the firm is equal to the value of equity or stock plus the value of debt. So if you apply a free cash flow to the firm as a cash flow measure, you have to discount it by the average cost of capital, which is the cost of equity plus the after-tax cost of debt. And the number you came out with dividing the future cash flow by the weighted average cost of capital, that is not the value of equity, that's the value of the firm. Because this cash flow is the wealth of both bondholders and the equity shareholders. So you have one more step. You have to subtract the value of debt to derive the value of stock. And sometimes the DCF, the discounted cash flow valuation, is too complex. So we use multiples, which is the relative valuation technique. Say the price to earning ratio is the industry standard, but remember, it's very sensitive to accounting tricks. So always check the earning quality. And the price to book ratio is your best friend when analyzing asset heavy sectors like banking or heavy industries like manufacturing, 중공업. And for those high growth tech startups that haven't turned a profit yet, you can apply the price to sales ratio. And the relative valuation is not about absolute value. It's about comparing apples to apples among peers. So it does not give you the exact intrinsic value. You have to compare this ratio with the peers to determine whether the stock is undervalued or expensive, overvalued. So use these multiples that face the company's maturity stage. And this was all for the preview for your final exam. And to wrap up our review, technical analysis is about timing. It gives you the entry and exit signal by watching price and volume patterns and those technical indicators. And security valuation is about a substance. It tells you the true intrinsic worth by discounting future cash flows. However, a vital word of caution for your final exam is that this review is designed as a very focused summary of core concept, not as an exhaustive encyclopedia of every single topic covered this semester. There may be complex questions, specific case studies, or detailed reasons addressed in the full original lecture PPT that are not fully detailed here. So therefore, to be thoroughly prepared for every potential exam question, you must read the full original lecture PowerPoint slide in their entirety. And on the exam, do not just dumb formulas. Explain the why. Why is the very important part. So when you write down the dividend discount model, for instance, mention why you choose that specific growth rate. When you draw a support line, explain the exhaustion of sellers behind it. So you have the tools, the trends, support or resistance, discounted cash flow techniques, or price multiples. So you're ready. Stay focused and trust your preparation, and good luck on your final. And lastly, I want to end this semester with a thank you for your hard work throughout this semester. Over the course of this class, we explored the foundation of investment theory, including asset pricing, valuation techniques, and market efficiency, and the analysis of financial ratios. We also discussed how investment decisions are made in real financial markets and how theory can be applied in practice. And I believe financial markets will continue to evolve, and new technologies such as the artificial intelligence, the AI, and investment products will emerge. But the fundamental principle we studied this semester remain essential. So whether you pursue a career in finance, business, or another field, the ability to analyze information critically or evaluate a risk and make informed decisions will always be valuable. And this final exam is the last step of the semester. So think of it as an opportunity to demonstrate what you have learned rather than something to be afraid of. So if you review the key concept and examples we covered in class, you will be well prepared. So thank you for your active participation, thoughtful discussions, and dedication throughout the semester. It has been a pleasure teaching you. I wish you all the best on your final exam and continue success in your academic and professional journeys. So good luck and thank you for a wonderful semester.